A staggering $28 price disparity currently exists between New York and Shanghai silver markets. This isn't a minor $2 spread or a modest $5 premium. It's a dramatic $28 gulf. While silver trades at approximately $75 per ounce on COMEX, that very same metal commands $130 per ounce in Shanghai. In any truly functioning market, such a significant imbalance should be rectified within mere seconds, certainly not persist for weeks. Every sophisticated trading algorithm on Wall Street, every arbitrage desk at major financial institutions, and every hedge fund with a dedicated commodities team has identified this anomaly. Yet, remarkably, no one is closing it. The stark truth is, no one can close it, because you simply cannot arbitrage an asset you cannot physically acquire. Welcome to the Money Truths. For those encountering my work for the first time, my mission is to illuminate the intricate mechanisms behind market dislocations, realities that mainstream financial media consistently overlook. I urge you to subscribe now, because what I am about to unveil is not speculative theory. It is derived directly from hard data. Cargo manifests, meticulous vault inventories, and refinery throughput figures that collectively prove we are witnessing the most significant wealth transfer in precious metals history, unfolding right this moment. Please smash that like button if you value this type of in-depth analysis. It helps ensure this critical information reaches others who urgently need to comprehend what lies ahead. Let's illustrate how arbitrage is designed to operate. A shrewd trader observes silver priced at $75 in New York and simultaneously sees it at $130 in Shanghai. Their strategy is straightforward. Buy in New York, arrange for shipment to Shanghai, sell at $130, and pocket a gross profit of $55 per ounce before logistics. Factoring in shipping and insurance for silver from New York to Shanghai, costs typically range from $2 to $3 per ounce. An additional $1.50 per ounce in refining fees is required to convert a standard COMEX good delivery bar into Shanghai kilogram bars. Let's conservatively estimate $5 per ounce for all-in logistics. This still leaves an extraordinary $50 per ounce profit. For a single shipping container holding 25,000 ounces, that translates to a pure arbitrage profit of $1.2 million, achievable within a swift 3-week turnaround. Without exception, every algorithmic trading desk on the planet is meticulously programmed to execute precisely these kinds of trades. So, the piercing question remains, why does this colossal price gap stubbornly persist? The foundational issue is that the quoted $75 COMEX price inherently assumes you can actually purchase physical silver at that price. It assumes COMEX vaults genuinely hold sufficient metal. It assumes you can reliably take physical delivery. It assumes refineries can convert your bars within reasonable timeframes. It assumes you can seamlessly export the refined silver from the United States without encountering regulatory impediments. And it assumes Chinese customs will clear your shipment without complications. Remove just one of these critical assumptions, and the entire arbitrage opportunity collapses. The uncomfortable reality is that every single one of these fundamental assumptions is now irrevocably broken. Allow me to detail the underlying causes. COMEX registered silver inventory, the actual metal available for delivery against futures contracts, stood at a robust 356 million ounces in January 2021, representing 5 years of a healthy, functioning market with normal delivery operations. As of late January 2026, however, COMEX registered inventory has plummeted to a mere 113 million ounces. Read those numbers again. A drastic reduction from 356 million down to 113 million. This signifies a stunning 68% collapse in deliverable inventory within just 5 years. But the situation is even more alarming. Reports from early January 2026 reveal that in a single 7-day period, an astonishing 33 million ounces of silver simply walked out of COMEX vaults. This wasn't merely traded paper. It was physically removed, loaded onto trucks, and gone. In 1 week, more silver departed COMEX than some entire national reserves currently hold. Currently, COMEX has approximately 500 million ounces of open interest in silver futures, 500 million ounces worth of contracts theoretically promising delivery. Against this, There are only 113 million ounces of actual metal physically available in the vault for delivery. This creates a precarious ratio of 4 for paper claims for every single ounce of real silver in the COMEX system. If just 23% of contract holders were to demand physical delivery, the vault would be completely empty, not merely stressed or tight, but utterly depleted. Now, let's connect these critical dots. On January 1, 2026, China unilaterally reclassified silver as a strategic, export-controlled commodity. This was not a mere recommendation or a tariff adjustment. It was a hard control. Silver now sits in the same strategic category as rare earth elements and advanced military technology. Under these stringent new regulations, a mere 44 state-approved companies are authorized to export silver from China. Not 400, not 40,000 independent traders, but precisely 44 government-sanctioned entities. To even qualify, a company must produce a minimum of 80 tons of silver annually and maintain substantial financial reserves, effectively limiting participation to predominantly state-owned or state-connected enterprises. Here's what this means in practical terms. China refines a staggering 60% to 70% of the world's silver. Most of this refining process involves imported silver concentrate sourced from mines in Mexico, Peru, and Australia. Historically, China imported this raw material, refined it into London Good Delivery Bars or Shanghai Gold Exchange kilos, and then re-exported a portion back to global markets. That critical supply loop is now irrevocably severed. China continues to import the concentrate, and China continues to refine it. However, this refined silver now remains in China unless the government explicitly approves its export through one of those 44 licensed entities. Crucially, those limited approvals are being directed towards Chinese solar manufacturers, Chinese EV battery makers, and Chinese electronics companies, not to London dealers attempting to cover short positions or New York arbitrage desks desperately trying to close the widening COMEX-Shanghai gap. You are invited to draw your own conclusions about whether the timing of this reclassification, effective January 1st, precisely when COMEX inventories plunged to crisis levels, was purely coincidental. Imagine yourself as an arbitrage trader today. You've finally managed to source 10,000 ounces of physical silver in New York, but at $80 per ounce. You had to pay a $5 premium over the COMEX quote because, frankly, no one is actually selling physical at $75 anymore. That's just the futures quote. Even so, you're still looking at a potential $40 arbitrage profit in Shanghai. Next, you face the indispensable step of converting your COMEX Good Delivery Bars into Shanghai Gold Exchange kilogram bars. A COMEX bar weighs 1,000 troy ounces, roughly 31 kilograms, while a Shanghai kilo bar is 15 troy ounces. You simply cannot ship COMEX bars directly to Shanghai and sell them. The Shanghai Gold Exchange does not accept them for settlement. They must be recast into kilo bars. Globally, there are perhaps only 6 refineries with the necessary capacity, accreditation, and throughput to perform this conversion at scale. Names like Perth Mint in Australia, Heraeus in Germany, Pamp Suisse, and a handful of specialized Chinese and Indian refineries. In normal times, this turnaround would take a mere 1 to 2 weeks. But we are far from normal times. Refineries are currently quoting extended 4 to 8-week delivery windows. Why? Because every arbitrage desk, every industrial user, and every sovereign wealth fund attempting to source physical silver is confronting this identical bottleneck. Refining capacity is inherently finite. You cannot simply spin up a new LBMA-accredited refinery in 90 days. So you wait 8 weeks. During this prolonged waiting period, silver prices inevitably fluctuate. Perhaps COMEX drops to $70 as more paper selling floods the market, or maybe Shanghai spikes to $140 as Chinese manufacturers engage in panic buying. Your initial $40 arbitrage profit could swiftly transform into a $20 loss, and you haven't even shipped the metal yet. This critical delay is precisely why the gap persists. The very mechanics required to close it are fundamentally broken. However, here is the insight that truly kept me awake last night. There's an enduring economic principle from the 16th century known as Gresham's Law. Sir Thomas Gresham, astute advisor to Queen Elizabeth I, observed that when 2 forms of money circulate simultaneously, one possessing real intrinsic value and the other debased or backed by questionable promises, the intrinsically valuable money invariably disappears from circulation, while the questionable money remains. In essence, bad money drives out good. For instance, when Henry VIII debased English coinage by reducing its silver content while artificially maintaining its face value, merchants immediately began hoarding the older, full-weight coins and spending only the debased ones. Rational economic actors consistently retain assets with genuine, tangible value and pass along substitutes with uncertain or compromised value. We are witnessing this precise phenomenon playing out in real time within the silver market. On one side, you have physical silver metal, a tangible asset you can hold, metal securely stored in an allocated vault with your name specifically linked to serialized bars. This is metal that cannot be conjured through financial engineering. It is genuinely scarce. On the other side, you have paper silver, COMEX futures contracts that nominally promise delivery but settle in cash an overwhelming 98% of the time. Silver ETFs burdened with force majeure clauses that permit them to suspend physical redemptions during vaguely defined, extraordinary market conditions. And unallocated silver accounts where your claimed ounces are, in fact, fractionally shared across multiple account holders. For decades, these two forms traded at essentially the same price because they were functionally equivalent. If you held paper silver and desired physical, you could convert it at par without issue. That crucial equivalence is now breaking down. The $75 COMEX price reflects the diminishing value of paper contracts, backed by a system where four claims exist for every single ounce of physical metal. The $130 Shanghai price, conversely, reflects the true value of actual physical silver you can touch, store, and utilize without inherent counterparty risk. Gresham's law accurately predicts precisely what we are observing. Holders of physical silver staunchly refuse to sell it at paper prices. They hoard it, patiently waiting for physical prices to genuinely reflect its true scarcity. Meanwhile, paper silver is flooding the market because its holders are increasingly realizing that their claims may not, in fact, convert to metal at the stated price. Bad money is aggressively driving out good. Here is the undeniable smoking gun. Observe what sophisticated money is doing. The iShares Silver Trust, ticker SLV, stands as the largest silver ETF in the United States. It holds silver in an unallocated form, meaning your shares represent a general claim on a pool of silver, not ownership of specific bars. Crucially, its prospectus contains force majeure language, empowering the trust to settle redemptions in cash instead of physical metal during periods of market disruption, a term notably undefined within the prospectus itself. Throughout late 2025 and early 2026, SLV experienced significant outflows. Investors are actively liquidating their positions. Concurrently, the Sprott Physical Silver Trust, ticker PSLV, has seen record inflows. PSLV, by contrast, holds 100% allocated physical silver, London Good delivery bars securely stored in Royal Canadian Mint vaults with complete audit transparency. Every share represents ownership of specific, serialized bars. Importantly, you can redeem for physical metal without force majeure exceptions, provided you hold a sufficient number of shares. On January 20, 2026, Sprott announced they were doubling their at-the-market equity program from $1 billion to $2 billion. This substantial capital raise is designed to enable them to purchase approximately 18 million ounces of additional physical silver. To put that in perspective, 18 million ounces represents a full 16% of the entire remaining COMEX registered inventory. A single, dedicated trust is actively preparing to buy 16% of all deliverable silver on COMEX. This is not the action of panicked retail investors. This is the calculated move of institutions possessing billion-dollar research budgets and legal teams that meticulously scrutinize every line of a prospectus. They are systematically moving capital from paper vehicles burdened with force majeure clauses to physical vehicles offering guaranteed allocated metal. They understand precisely what is coming. Now, here's what should truly astound you. Technology giants are entirely bypassing traditional exchanges and securing physical supply directly at the source. Tesla, for instance, reportedly acquired a staggering 85 million ounces of physical silver in mid-January 2026. This wasn't COMEX futures or SLV shares. It was 85 million ounces of actual physical metal, executed through direct mine contracts, vault acquisitions, and off-market deals assembled in a mere 72 hours. That single purchase alone equates to 75% of the total COMEX registered inventory. Tesla bought 3/4 of all silver currently available for delivery on COMEX, and they achieved this without even touching public markets. Similarly, Samsung has negotiated an exclusive offtake agreement for 100% of the Laparilla silver mine's output for the next 2 years. They effectively own the mine's production before it even emerges from the ground. That silver will never see a vault, nor will it ever trade on an exchange. It flows directly from the refinery to Samsung's battery production lines. Apple, according to credible reports, has conducted extensive internal scenarios modeling potential silver supply disruptions. Their worst-case valuation, a staggering $573 per ounce. This is not because they view silver as an investment at that price, but because the catastrophic cost of a production line shutdown due to a lack of silver components vastly exceeds the cost of paying $500 plus per ounce to guarantee supply. When an iPhone assembly line generates $200 million per day in output, paying virtually any price for assured silver supply becomes an economically rational imperative. Read those numbers again. Tesla, 85 million ounces removed from the market. Samsung, 2 years of mine output exclusively locked up. Apple, willing to pay $573 per ounce if absolutely necessary. These are not companies speculating on silver prices. These are companies recognizing, with stark clarity, that the traditional commodity exchange system can no longer guarantee them supply. Consequently, they are integrating backward, aggressively locking up upstream production, and removing silver from tradable markets entirely. They are, in essence, hoarding the good money. So what happens next? The $28 gap cannot be closed through normal arbitrage because every single mechanism essential for arbitrage to function is irretrievably broken. Consider mechanism 1. Supply response to price signals. In typical commodity markets, when prices double, miners predictably increase production. Existing mines ramp up output. New mines secure financing. Marginal deposits become economically viable. Supply expands, and prices eventually moderate. Silver, critically, does not operate this way. A significant 70% of mined silver is a byproduct of zinc, copper, and lead extraction. Silver supply is therefore primarily constrained by base metal economics, not by the price of silver itself. A copper mine facing declining or grades will reduce its output, even if silver is trading at $150 per ounce, because the mine's overall economics are driven by copper, not silver. Consequently, price signals simply do not increase silver supply on any relevant timeline. Furthermore, new primary silver mines require an arduous 7 to 10 years from initial exploration through permitting, financing, construction, and first production. A mine commencing production in 2026 reflects exploration decisions made as far back as 2016, when silver was a mere $15 per ounce. Projects responding to 2026 prices will not yield metal until 2033 or even later. The market, quite simply, cannot wait 7 years. Now, consider mechanism 2. Demand destruction. In normal markets, when prices spike, demand typically collapses. Consumers find substitutes or defer non-essential purchases. This, too, is emphatically not happening with silver. Solar panel manufacturers cannot simply pause production because silver costs have surged. They are bound by contracts, installation deadlines, and government subsidies with looming expiration dates. They will pay the higher silver price and pass those costs to customers, or they will be forced to shut down entirely and destroy shareholder value. They will pay. Electric vehicle manufacturers developing cutting-edge solid-state batteries with silver-carbon anodes cannot substitute copper or aluminum. The technology specifically requires silver. They either secure silver supply or are forced to abandon entire product lines after billions in R&D investment. They will pay. AI data centers cannot defer construction simply because silver has become expensive. The immense power density requirements and sophisticated thermal management in high-performance computing demand silver. The financial cost of delaying data center deployment exceeds the cost of even expensive silver by orders of magnitude. They will pay. This is a critical confluence of inelastic demand meeting severely constrained supply, compounded by broken arbitrage mechanisms. The gap will not close. It will only widen. Here is what I am watching with acute attention. COMEX March 2026 silver contracts currently represent over 500 million ounces of open interest. Against this, registered inventory stands at a paltry 113 million ounces. If just 23% of those contract holders demand physical delivery instead of a cash settlement, COMEX simply cannot fulfill the obligation. Every COMEX futures contract contains a force majeure clause. This language explicitly permits the exchange to suspend physical delivery during extraordinary market conditions and to settle contracts in cash at a price determined by the Exchange Settlement Committee. That language is deliberately vague. The exchange itself defines what constitutes extraordinary conditions. The exchange itself determines the cash settlement price. Imagine if COMEX invokes force majeure on March contracts and forces a cash settlement at, say, $85 per ounce, while physical metal is simultaneously trading at $130 in Shanghai. What would be the consequence? Every futures trader holding contracts expecting $130 metal would be settled at $85, a staggering $45 per ounce loss imposed by exchange fiat. That is not a functioning market. That is unequivocally expropriation. The credibility damage to COMEX would be terminal. Every industrial user, every sovereign wealth fund, every institution that relies on futures for hedging would instantly recognize that COMEX can no longer guarantee physical delivery. The migration to physical markets would accelerate overnight, and Shanghai would become the global price discovery center by default, precisely because Shanghai still delivers actual metal. I am not predicting this will happen. I am stating with absolute clarity that the mechanics exist for it to happen, and inventories are now at levels where it becomes terrifyingly possible. Possible is often all it takes to violently move markets. Over the next 60 days, here are the key indicators I will be scrutinizing. COMEX registered inventory asterisk. If it drops below 100 million ounces, the mathematical impossibility of meeting delivery obligations becomes undeniable. We are currently at 113 million ounces. Just one severe week of withdrawals could put us below that critical threshold. Shanghai physical premiums asterisk. If the premium of Shanghai silver over COMEX silver consistently exceeds $40 per ounce and sustains for more than 2 weeks, it will unequivocally signal that arbitrage has completely failed and the markets have permanently bifurcated. Silver lease rates asterisk. These rates represent the cost of borrowing physical silver against dollar deposits. Normal lease rates are typically below 2% annually. In late 2025, they surged to 35%. If lease rates exceed 40% and hold at that level for more than 72 hours, it signifies that physical silver is virtually unavailable at any reasonable cost in London and New York. Refinery delivery windows asterisk currently quoting 4 to 8 weeks. If major refineries extend their quotes beyond 12 weeks or, more critically, cease accepting new orders entirely, the conversion bottleneck will have escalated into a total gridlock. ETF divergence, SLV versus PSLV. Observe the premium or discount between SLV and PSLV shares. SLV is unallocated with force majeure clauses. PSLV is allocated without such protections. If PSLV shares begin trading at a 10% or greater premium to their net asset value, NAV, while SLV trades at a discount, it will powerfully indicate that institutions are actively pricing in the high probability of an SLV force majeure settlement. These are not speculative indicators. These are objective, mechanical measures of systemic stress. When multiple indicators flash red simultaneously, the system is demonstrably in failure mode. Markets in such extreme conditions separate survivors from casualties, not based on who perfectly predicted the exact top or bottom, nor on who possessed flawless information. Survival hinges on who recognized the fundamental structural break and strategically positioned themselves accordingly, before the broader crowd comprehended what was truly unfolding. Physical silver holders recognized months ago that paper and physical silver were decoupling. They diligently moved their capital into allocated metal and withdrew it from exchange vaults. They are not frantically checking prices every 15 minutes, nor are they panicking about temporary drawdowns. They are calmly awaiting the inevitable reconciliation between paper and physical. Conversely, paper silver holders, traders in COMEX futures, holders of unallocated ETFs are now confronting the harsh reality that their $75 positions do not, in fact, convert to $130 metal. Some will be force majeure settled at exchange-determined prices. Some will be compelled to exit at significant losses. Some will choose to hold on, desperately hoping the gap closes through mechanisms that no longer function. These individuals are the casualties of a system that explicitly promised fungibility between paper and physical, a promise that is now unequivocally breaking. Someone will survive this. Someone will staunchly hold physical metal through the coming panic and sell it when clarity finally returns, at prices that truly reflect genuine scarcity. Someone will recognize that the $28 gap is not a fleeting arbitrage opportunity. It is a profound signal that the entire commodity market structure is collapsing. That survivor could be you. Or you could be the trader who blindly assumed COMEX delivery would always work, right up until the exchange declared force majeure and settled your position in cash at a devastating 30% discount to the actual physical price. One of these outcomes involves a clear understanding of what you have just witnessed. The other involves a dangerous assumption that the system still functions as it did 5 years ago. Choose accordingly. I invite you to drop your thoughts in the comments below. Are you holding physical or paper silver? Are you meticulously watching the COMEX registered inventory? Have you recently attempted to source physical silver from a dealer and encountered unexpected delivery delays? I genuinely want to hear what you are experiencing on the ground, because while the data I track is macro level, your direct experience fills in the crucial gaps that vault reports simply do not show. If you found value in this video, please share it with someone who truly needs to see it, not for algorithmic metrics, but because there are countless people holding paper silver who do not understand the force majeure clauses buried within their prospectuses. There are people still assuming the $75 COMEX price means they can readily acquire physical metal at $75, and that dangerous assumption is going to cost them dearly. Sharing this information could be the critical difference between someone making an informed decision and someone discovering they are a counterparty to a broken contract when it is far too late to exit. Please subscribe to this channel if you haven't already. I am committed to covering the silver decoupling phenomenon daily, until it definitively resolves one way or another, either through a COMEX force majeure and a formal market bifurcation, or through Shanghai premiums somehow compressing as supply miraculously normalizes. Either way, you will find it analyzed here first, backed by the raw vault data and cargo manifests that the financial media will simply refuse to touch. See you tomorrow. We are just getting started.